The macro situation we are facing right now is eerily similar to what we saw back in 1929. That's why I believe that after this rally ends, we could see one of the largest depressions in US history since 1929, when of course we had the dreaded Black Monday and Black Tuesday. The stock market lost over 30%, and it took over a decade for stocks to recover their pre-1929 prices. So let's begin by talking about why I think today's macroeconomic situation is quite similar to 1929, then how I believe the following crisis will unfold, which will be a massive deflation, and third, when I think markets will bottom. I'll give specific targets using technical analysis, and also my expectations of how the Fed will react and what we will likely see markets do over the next 10 years. So, first off, what actually sparked the 1929 Great Depression? Now, economists still don't completely agree with this, but at the very least, we can point to certain factors which contributed to, first of all, allowing markets to reach valuations that were just absolutely crazy for the time, and B, factors which eventually led to the deflation or what we could call a massive stock market bubble. First off, stock market valuations were allowed to go so high because of rampant stock market speculation. Now, I'm not saying speculation is all in all bad. However, the amount of speculation in 1929 was really out of control. In fact, regular everyday banks were loaning as much as 80% on margin to everyday retail investors. This is what actually propelled the Roaring Twenties and the massive stock market rally we saw leading up to the 1929 decline. Now, of course, we had stocks at crazy all-time highs, sentiment was at a fever pitch, but what exactly was it that toppled the stock market? What was the catalyst that led to the stock market crash and to the following years of depression? One factor we can definitely point at was the Smoot-Hawley Tariff Act. This was the second largest import tariff on foreign goods in US history. In other words, the US government decided to levy huge taxes on imported goods, thereby crippling global trade. The problem was that this also led to retaliation. Therefore, the Smoot-Hawley tariff actually led to a continued protectionist fight and really crippled global trade, which of course had a terrible impact on markets. On the other hand, if we look at the money supply in the United States, we can see that during this decade, it contracted one of the fastest paces in US history. So what we had was incredibly high valuations for stocks. Then we had an external shock, which was these tariffs imposed by the government and which eventually led to a stock market crash. This was amplified by the fact that a lot of the buying was happening on margin which was facilitated by everyday banks. So of course, the stock market crash translated into a huge problem for the banking sector, which saw hundreds of bankruptcies over the coming years. And of course, this in turn translated into the broader economy. Back then, of course, there was no such thing as federal deposit insurance, so many people lost their bank deposits. Of course, defaults on loans happened, and this eventually bled into employment and the general economy. And of course, following the boom cycle of the 1920s, we got the bust of the 1930s and the Great Depression, which saw levels of unemployment reach record highs. The Keynesian explanation to the Great Depression is that a lack of demand eventually triggered this kind of inverse wealth effect. Now, the monetarists would also add to this that the effects of the Great Depression were greatly exacerbated by the fact that there was a huge reduction in the money supply, which in fact we can see in this chart. Monetarists like Milton Friedman would argue that the Fed was not fast enough in responding with monetary stimulus, and by allowing the monetary supply to reduce at that degree, it exacerbated deflation, which in turn made the depression even worse and longer. Now, why am I saying that today looks a lot like 1929? Well, let's sum up the three factors that contributed to 1929. Stock market speculation, a breakdown in global trade, and a huge decrease in the money supply. Three factors which are very present today. Now, in this chart here, we can see the evolution of margin debt since about 1997. Notice how, of course, margin debt tends to fluctuate with valuations in the stock market, and we tend to see margin debt peak ahead of economic recessions and stock market crashes. Now, while this information isn't completely up to date, today's levels aren't particularly high, however they are quickly climbing. And even though margin debt in itself isn't quite as high, there are many other forms of speculation happening in the stock market today. I'm of course talking about the phenomenon of zero DTE options. Options that have 0 days to expiry. In other words, options that expire on the same day they are issued. This form of short-term speculation has become really popular in the last few years. In fact, go ahead and look at this chart. You can see short-dated SPX volume as a percentage of total volume has reached over 40%. According to JP Morgan, the notional value of these has reached over $1 trillion per day. Just to put that into perspective, the total market cap of the US stock market is around 20 trillion. In my opinion, this is evidence that stock market speculation has completely got out of control. And of course, we can also add to this the fact that many retail traders are now piling into this with margin options through platforms such as Robinhood and other platforms which make it very easy for anyone to use leverage and basically speculate on the stock market. Now again, there is nothing inherently wrong with stock market speculation. I believe in a free market, and speculation is simply a part of price discovery. However, these kind of imbalances can certainly lead to a lot of volatility. And by volatility, I mean the potential of a huge crash. Secondly, breakdown in global trade. The Smooth-Hawley tariff in 1929 really took a toll on the economies. Of course, again, being a free market economist, I believe that global trade is overall pretty good for markets and for the economy. However, we are seeing a breakdown in global trade, basically caused because of geopolitical tensions. Just go ahead and look at how China's exports have fallen since 2016. And this, of course, is slowly escalating. The US, for example, has already issued bans on the microchips that can be exported to China, and many different countries. We have the ongoing conflicts in the Middle East and with Russia and Ukraine. This is all contributing to what I would call a breakdown in international relations and will eventually lead to a breakdown in trade. Already, defense spending around the globe is expected to reach new all-time highs in 2024. This trend is definitely going to continue, and eventually the market is going to feel it. Now, lastly, I also wanted to talk about the money supply. Now, as we can see, the growth in M2, which is broad money, has always been strongly correlated with inflation and deflation. Back in 1932, inflation dropped to minus 10.4%, while M2 growth is minus 11.8%. Looking at this chart, I would say M2 growth is the leading indicator of inflation and deflation. Now, if we look at the more recent years, we can see that M2 has been collapsing in 2022 and 2023. This would imply that we could see a huge reduction in inflation and even deflation starting later this year. Now, based on this, I believe we could be very close to a turning point in markets. However, even if we do get something similar to the Great Depression, I will say that I don't expect it to be quite as bad as back then. There are a few reasons for this. First of all, today we have a lot of things in place to prevent the kind of widespread panics and contagion that happened back in 1929. For one thing, we have federal deposit insurance. On top of that, the Fed has been a lot more active in recent years when it comes to helping out markets in times of crisis. Now, this doesn't mean that the Fed can avoid a crisis, because as we saw in 2008 and 2019, the Fed isn't all-powerful. However, it will certainly contribute to, at least in nominal terms, stopping the pain a little bit quicker for the stock market. Now, I always like to underpin my fundamental analysis with some technical analysis, and in this case, we have a very good correlation between what we expect fundamentally and our technical outlook. Let's go ahead and look at this long-term Elliott wave chart. Over here, this chart outlines the long-term Elliott wave count, dating all the way back to 1850. As we can see, the rally into the 1930 top can be seen as a wave 1, the following sell-off was a sharp decline in wave 2, and we have now been in a wave 3. This wave 3 is projected to end pretty soon, which would then give place to a wave 4. Based on the fact that the last wave 2 was pretty sharp and quick, would imply that the wave 4 should be long and maybe a bit more shallow. Still, the fact that this is a large degree wave 4 means we could have a long way down. Over the next few years, we could see a decline into the bottom of the trend line, which is down at about 1500. If we measure the approximate length of wave 3, which hasn't topped yet, we can see that the minimum target for a wave 4 lands at a similar area as shown above, around 1400. That would be the 21.4% retracement level. Lastly, looking at the latest action, we could also argue that the SPX is in a rising wedge, which would end with a breakdown of the chart. Also, notice the high divergence in the monthly chart. Once the RSI hits that trendline, it could be game over. Zooming into the more recent action, we can see how a 5-wave structure has been developing to complete this last wave 5. The way I see it, we are now topping in a wave 3, so we still have a retracement in wave 4, a final rally in wave 5, which will probably get us way past 5,000, even into the point of 6,000, and then, and only then, would we begin our Great Depression style sell-off and bear market, which could last anywhere from 5 to 10 or more years. Again, looking at the more immediate action, we could have a wave 4 that takes us back towards 4,600 and then sets us up for that rally into new all-time highs. Now lastly, I also wanted to complement this with this kind of infamous chart that has been circling the internet for some time. Check it out. This chart was developed by Samuel Banner, a pig farmer. who wrote a book back in 1875. Samuel Banner actually identified this curious cycle. The cycle he identified moves based on 3 time sequences: prosperity in a 16, 18, 20-year pattern, commodity price lows in an 8, 9, 10-year pattern, and recessions in a 5, 6, 7-year pattern. To be clear, a 16, 18, 20 pattern means that you should expect 16 years between the first 2 prosperous periods, 18 years between the next 2, and 20 years between the following 2. After that, it goes back to 16 years between them. It sounds a little bit complex, I know, but if we just look at the chart, we could basically simplify this and just look at the highlighted areas A, B, C, and how they correspond to different years. Simply note that, for example, if you were to have sold your stocks in the B zone, 1926, 1999, 2007, and 2019, you would have avoided some of the major crashes we saw in Zone A. Likewise, if you bought the lows in Zone C, you would be sitting quite pretty right now. As we can see, 2023, for example, was highlighted as a great time to buy in that Zone C, and we did indeed see a stock market bottom and a pretty strong rally since then. Now, what's interesting is that according to this chart, we should see stocks continue to rally up until 2026, at which point we would see another big sell-off. Following this sell-off in 2032, we'd probably see a stock market rally until 2035, and then a final big stock market crash all the way down to 2039. Now, of course, it's pretty much lacking a lot of fundamentals. However, it is really interesting that such an old chart has managed to predict so many of the recent sell-offs in markets. Now, once you combine this chart, Elliott wave theory, and the fundamental analysis, we can see that there's some very compelling reasons to say that stock markets could sell off strongly in the next few years, that we could see a long bear market take place, and that therefore, investors should be prepared for this. As always, I hope you enjoyed this video, and if you like this type of macro content and you do indeed want to be prepared for the coming bear market, go ahead and subscribe and check out my Substack. I do a lot more there: weekly macro reports, in-depth technical analysis, and stock reports. Thanks for watching, and I'll see you in the next one.